Hello, my name is Robert Reilly, and this is the Quick Tip of the Week. The topic we're going to talk about this week is consideration of the repurchase liability in an employer stock valuation. And this is the outline of the topics we're going to talk about specifically. First, it's important to note that ESOP plan participants have the right to put their allocated shares and the sponsor company stock back to the sponsor company under certain specified conditions, and these are conditions that are specified by ERISA. Secondly, this repurchase obligation is really a liability. Now, it's not recorded as a liability under GAAP, but it is a contingent liability, and it has a direct impact on the sponsor company cash flow and therefore on the sponsor company stock value. And that impact must be considered, and that's really what we're going to be talking about. In the sponsor company stock valuation, the analyst, the valuation analyst, you and I, should consider all of the factors that affect this repurchase liability, because one way or another, we're going to have to factor in this repurchase obligation or repurchase liability, and those terms are synonyms, in our employer stock valuation. Now, we can factor in that repurchase liability either by making an implicit adjustment in our valuation or by making an explicit adjustment in our valuation. And either type of adjustment is appropriate, but we have to make one or the other. We can't ignore this repurchase liability. In addition to making the adjustment, we have to realize that the adjustment should be made or should be at least considered in each of the valuation approaches and methods that we use. So we don't want to make an adjustment in one approach only and neglect to make a similar adjustment in another approach or another method. Finally, it's important to recognize that the employer stock final value conclusion should reflect the expected impact of this ESOP repurchase liability. So the ESOP sponsor company has a repurchase liability, and that should be considered in the final value conclusion that we reach. Now, what is this repurchase liability, and why is it unique to ESOPs? And really, I think it's important to note it is unique to ESOPs. If you're valuing the same type of company and the same size company in the same industry that's not an ESOP-owned company, you don't encounter this ESOP repurchase liability. Well, ERISA provides a put option for employees under certain circumstances. And the certain circumstances are an employee who's separated from service, or has to be a retired employee, who's one, over the age of 65, or the normal plan retirement age. So if the actual plan document calls for retirement at 62 or 60, then you'd have to, the employee can put the stock back at an earlier age, but it can't be over 65, and the employee must have 10 years of plan participation. So the plan has to be around, and the employee has to be an employee for at least 10 years to have this put ability, the ability to put their stock back to the company. The put option payments must be made by the sponsor company to the participant either in terms of cash or in terms of a note with interest. So the sponsor company, when the employee puts the shares of stock back to the sponsor company can give them a check, or they can give them a note, and the note can be paid out over 5 years with a statutory interest rate. But in either case, obviously that's a cash flow outflow to the sponsor company. In addition to the retirement ESOP put, ERISA also provides for what's called a diversification option for qualified participants, and that's an ESOP, rather an ERISA term. But a qualified participant is an employee who's over the age of 55 and who has 10 years of plan participation. Now, what happens with those employees, so obviously these are people who are a little bit younger than the retired employees who are putting their stock back. These are people who typically are still employees, but in their last 10 years of retirement, they can go to the ESOP, which really means go to the sponsor company, and initially say, I want my account to be diversified up to 25% of my ESOP account, and that increases after 5 years, 50% of my ESOP account. So if the ESOP account is, say, $500,000, and in the first time the employee reaches age 55, they can say, I want to have my account diversified out of the employer stock and into either cash or other liquid investment options. By the time the employee reaches 60 years old, the employee can say, I want 50% of my account. In my example, $250,000 of my $500,000 account. I want that diversified out of the employer stock and into either cash or readily liquid investment options. Something else to keep in mind is many ESOP plans have put options and diversification opportunities that are even more generous than required by ERISA. What we've talked about so far are the minimum requirements under ERISA. You really need to look at the plan documents or talk to the plan administrator and find out if the plan for the sponsor company you're appraising has benefits that are even more generous than the ones we've been talking about so far. Now, obviously, in all cases, these benefits, this repurchase obligation and the diversification benefit, has a downward effect on the FMV, the fair market value of the sponsor company stock. Well, why? Well, because it means there's cash going out the door from the sponsor company to the ESOP participant. There are 5, typically, we'd recognize there are 5 factors that influence exactly how much the repurchase obligation is going to affect the sponsor company fair market value. The first of those 5 factors are the plan payout terms. Is when the employee puts the stock back to the company, does the company pay for the stock right away with a check, or does the company pay for the stock over 5 years with interest, as we talked about? Well, that makes a difference. The second factor is whether the ESOP trust or the sponsor company buys the stock. Those are 2 different options. In most cases, it's the sponsor company itself that buys the stock back from the retiring employee. In some cases, it's the ESOP trust, a separate entity, that buys the stock back from the employee, and you'd want to know which is which. Third, the question becomes what happens to the repurchased shares? And we'll see in just a second there are different options as to whether the shares are retired or recycled. Fourth, what's the census of the current employees? Are most of our employees 25 years old, and we think they're not going to retire for another 40 years, or are most of our employees 60 years old, and they're going to retire in 5 years? Well, that's going to make a big difference on our repurchase obligation. Then the final factor is what's the current stock fair market value and the expected growth rate of the fair market value of the stock. In other words, are we appraising the stock today at $14 a share or $1,400 a share? Is the stock expected to grow at 2% a year or 20% a year? That will affect the repurchase obligation. Now, of the factors we just talked about, one that's particularly important, well, they're all important, but one that's particularly important is the repurchase method. And the question is, what happens to the shares when the employee reaches age 65, has 10 years of service with the plan, puts their stock, literally hands the shares of the stock back to the company? What happens to that stock? Well, there are 3 most common methods, and the 3 most common methods are the redemption method. The sponsor company repurchases the shares, pays for the shares, and then cancels the shares. So in that case, the number of shares outstanding decreases after the employee retires. The second method, a little bit less common, is the recycling method. And in that case, the sponsor company, again, repurchases the shares, pays the employee for the shares, and then contributes those shares to the ESOP and takes a contribution expense deduction on their income tax return. But in that case, the number of shares outstanding stays the same. It's not reduced because the shares now go into the ESOP. The third method, the least common method, is what's called the ESOP investing method, and that's where the ESOP trust itself repurchases the shares from the employees using cash that obviously was contributed from the company to the ESOP, and then the ESOP allocates those new shares, they're not new shares, but they're repurchased shares, to the remaining ESOP participants. So obviously, which method is used at the company you're appraising is going to affect the cash flow of the company you're appraising. So how do we determine the amount of this repurchase obligation? Well, basically, there are two different ways. The way we would prefer as valuation analysts is that the sponsor company, the employer corporation, provides us with a professionally prepared repurchase obligation study prepared by an actuary. And in that case, we know down to typically to the dollar what this repurchase obligation is, and we can adjust each of our approaches and methods for this amount. So if we have that repurchase study, it will say, as of a certain date, the company's repurchase obligation is X million dollars, a specific dollar amount. And we can adjust each of our valuation conclusions for the conclusion of the repurchase study. Now, not every sponsor company has a repurchase obligation study. You can argue that they should, but many of them don't, in which case the analyst, you and me, we have to implicitly consider the impact of the repurchase obligation on the employer's stock value. In other words, we have to go into our individual variables, such as what's the effect of this extra risk on the company's present value discount rate, on the pricing multiples that we select in our market approach, in the terminal value multiples that we select in our income approach. We'll have to judgmentally affect the valuation or adjust the valuation variables that we select based upon a perceived order of magnitude of this repurchase obligation. So in that case, the valuation analyst, you and I, adjust the valuation variables for each approach and each method in order to implicitly reflect the extra risk associated with this cash flow obligation that's going to occur in the future, but for which we don't know an exact dollar amount because we don't have a repurchase obligation study. Now, as I mentioned earlier, the repurchase obligation is a factor that you're not going to consider in a non-ESOP valuation engagement. So if you're looking at a similar-sized company, I mean, exactly the same size company in exactly the same industry, but it's not ESOP-owned, and you're valuing that company for gift tax, estate tax, whatever other purpose, you don't have to consider the repurchase obligation. This really is a factor that only comes up in valuing ESOP-owned stock for ESOP valuation purposes. But for this purpose, it's a very important consideration. And I can't emphasize enough that the ESOP repurchase obligation represents a real cash flow obligation of the sponsor company. When the employees hit retirement age, they can literally come back to the company, hand back their shares of stock, and expect cash. They can either get it up front or over a payment schedule. They expect cash, and the company has to pay that cash, either directly from the company, most commonly, or by making contributions to the ESOP trust, and then the ESOP trust buys the stock. Either way, the cash is coming out of the company. And therefore, either way, the repurchase obligation is going to impact the fair market value of the sponsor company. So the evaluation analyst can consider, as I mentioned, the repurchase obligation on the employer's stock value, either implicitly by adjusting the valuation variables within each approach and each method that we use, or explicitly by making a specific dollar adjustment, which we would do if we had an actual repurchase study in our hand prepared by an actuary which concluded a specific dollar amount. But in all cases, we really do need to consider how close the employees are to retirement, how many employees will retire, when they'll retire, what the stock price will be when they retire, so we can have some type of estimate of this cash flow obligation associated with the repurchase liability, and we need to consider that in the employer stock valuation. So in conclusion, I would like to say simply thank you for your attention, and remember that in the case of the employer stock valuation, unlike the valuation of other companies for other purposes, we really do need to consider the repurchase obligation as either an implicit adjustment or an explicit adjustment to our final fair market value conclusion of the sponsor company stock. So again, thank you for your time and attention, and good luck to you in performing your ESOP stock valuations.